Welcome everyone. My name's Mark Heimer. I am a board member for SaskSoil, and I'm going to be helping host tonight. Um, this this is our first webinar. So if I could ask everyone to be a little bit patient, that would be very helpful. We may experience a few glitches or blips every once in a while, but also if you wouldn't mind giving us a little bit of feedback as to the kind of speakers or topics you'd like to hear about in the Q&A. Or if you just want us to monthly talk to Dallas and we just come here and talk cows and grass once a month, that fully works too. But so the chat for this evening is disabled, and we don't know how to turn it back on, but we'll get better at that. So put any comments you need to throw in the Q&A. So our organization, SaskSoil, is a nonprofit that's mission is to help producers improve the quality of and improve the health of their land. We do that through a variety of ways. We do an annual conference. We do field days throughout the summer, getting producers out on the land and showing them all sorts of different things. But starting now, we also are putting on a few webinars. If this is the kind of thing that you are interested in, head over to our website and sign up for our newsletter, or even better yet, become a member. And that is sasksoil.ca, I believe. So today is brought to us, webinars are funded and helped out by the FARM program. That stands for the Farm Resilience Mentorship Program. It is designed to help producers who are interested in improving or learning about nitrogen management, cover cropping, or rotational grazing skills. They provide courses and resources to help producers along, which you will also be able to find links to on our website, as well as help fund events like the one this evening. So a big thank you to the FARM program. A little bit of housekeeping for this evening. The format of this webinar will be Dallas giving his presentation, followed up by a Q&A. We may interrupt Dallas if he gets horribly boring partway through the middle. We'll jump in with some questions, and we'll try to do that. So if you got a burning question in your mind, throw it in the Q&A boxes, and we'll try to get her answered. Yeah, like I mentioned, the chat is going to be disabled, and I think that's pretty much it. So we'll get going. I'll introduce Dallas here. Dallas is the owner of Ranch Management Consultants, Home of Ranching for Profit School, as well as the Executive Link program. Dallas has led Ranch Management Consultant since 2019, worked with hundreds of ranchers across US and Canada, Australia, position their businesses for economic profit and ecological health. SaskSoil was fortunate enough to be able to bring Dallas in for our conference this past February, and he was so well received, we thought we'd bring him back for a little bit more. So welcome, Dallas. We're glad you could be here.
Great. Yeah. Thanks, Mark and Daniel. Glad to be with you. I am seeing some stuff pop up in the chat box. Are you guys seeing that as well, Mark? And just see some stuff there, but so I guess
working. Yeah.
Okay. So we're good. Right. So if they want to do it in the chat or in the Q&A, we're good for those. Okay.
Yeah, right. Absolutely. If we can throw the keep general conversation in the chat, we'll try to focus on the Q&A for the questions, just so we can keep track of them a little bit better.
Great. Yeah, and I've asked Mark and Tanya to jump in and interrupt me as we're going, so it's not just me talking at you guys, that we get to have some more of a conversation feel to it. So I'd love it if questions were coming along, and we can dive into those as they pop up. So Mark, give me a thumbs up. Are you guys seeing that screen? Good. Am I popped up? All right. Awesome. So I'll roll through introduction here. Mark did a great job doing that. So most of you, I hope, are aware of Ranching for Profit. We've been around about 40 years. I'm the third owner of the company, following Stan Parsons and Dave Pratt. Many of you guys probably know those two folks. They've done a lot. This is our current team. This is our delivery team. So this is our group of folks that are doing instruction for the school. We got an amazing group that we work with, and I bet some of you have had the chance to work with some of these folks. So our mission is healthy land, happy families, and profitable businesses. So we are all about that. We get really excited about that mission. So Mark had mentioned we teach the Ranching for Profit School. That's the main thing that we do. That's a 6-day school. We teach it about a dozen different locations each year. I'll share some dates with you at the end. We'll be up in Canada, I hope, for at least 2 weeks this year. But we always seem to have quite a few Canadians come down and take schools with us in the States as well. So, the other thing we do is Executive Link, which is a peer advisory network structure where we put businesses on boards of directors for each other. And a lot of the things I'm going to share with you today, really the lessons that I learn are from working with ranchers in the Executive Link program. And when they're in, we call it EL for short. So if you hear me refer to EL, we're talking about Executive Link. When folks are in EL, they share their financials every quarter with our group. So we get a look in pretty deep at the ranch financials. And so when we're talking about the economics of good grazing, that's where a lot of our data is coming from, is those businesses that we work with through EL, and sharing that. So that was a snapshot of the businesses we worked with that year. We didn't have all of our Canadian schools in this data set, so it's not reflective of those. But and then this is our place here. This was a couple years ago. This is about 45 days out from right now, so I'm looking forward to having that much grass again if we keep getting rain. But I always like to show this and just tell folks that everybody that does grazing, there's like one day of the year where it feels like things go well, right? And everything kind of lines up. And this video was taken for me on that one day of the year. I just picked up the polywire, looked back, cattle were walking in. I liked what I was leaving. I liked what we were going. Cow condition looked good. So, but we have a couple of places that we manage. This is what we call our lower place, the bottom ground. This is sub-irrigated. Some of that's so wet, it kind of does the whole, the floating sod thing. But then there's other places that are a little firmer like this. And then we have another ranch that's about 40 miles west of where I live in Wheatland, Wyoming. This is at about 7,500 feet. This is up on a mountain pasture, and we take cattle up there. So we have two different grazing programs we run. One is a very intensive program, which was picking up the polywire and seeing the cattle move. And this one is a very extensive grazing system. So we kind of have the best of the two different worlds there. So let's talk economics of grazing, and let's look at economics of good grazing. And as we look at economics, it's going to be a lot to do with deployment of capital, right? So how do we deploy our capital? Where can we invest? Putting it into grazing infrastructure is one of those investments. But let's take a step back and say, all right, so if we had a profitable year, so let's all just say, let's pretend we're running a ranch, and let's say, hey, we have $100,000 of profit this year. Okay, so we've finished our year, paid everything off, and we've got $100,000 of profit. What do we want to do with it? Okay, what could be some of those uses of profit? So as we look at the broad uses of profit, I would put them into these categories. And if we were together in person, we would brainstorm these together. But this is where I would think most of those would fall into. So obviously we could take some of it and throw against any debt we're carrying, right? So you might want to say, let's pay down some debt, right? I'm like to get after that stuff. Okay, that could be a good use, or it could not be a good use. We could talk about the reasons why. Let's build reserves. Okay, great, love it. Let's save some money for a rainy day. Put ourselves in a position where, when things go bad, we're going to have some things to lean on. Let's throw it back in the business. Okay. Now, this is where grazing infrastructure, in my mind, would fall. It's developing water, putting in fence, doing those kind of things to be better at grazing, doing virtual fence. Those are investments back into the business. So there's a use of profit. Start a new business, right? Let's take some of that and go out and do something else with it, right? Maybe something other than ranching. Dividends to ownership. Okay. Well, this is a farm. We don't do that, right? That would be crazy. Okay, but that that's what a normal business would do, right? Or could do. Donations, give it away. Just give it to something we care about, which I bet most of our clients, and I bet most of you do that with a portion of your profits. So there are the different main categories of what we could do with profit. So what I would encourage you guys to do is you're thinking about, if I imagine some of you have had especially the more livestock business you are, it's been a pretty dang good year. And maybe we're looking at another one ahead of us. So as we start looking forward and thinking about profit, I want to encourage you to be thoughtful about the different uses of profit and what we can do with it. Okay. When we do this at the full school, we actually go through an exercise where we help you identify your profit target. Okay. And the way we do that is we get very specific about goals under each of these categories, right? What is your target for paying down debt? Now, obviously, some of that you probably have to make minimum debt payments, right? So that's going to be part of that profit target, but maybe some of you want to accelerate that. Do you have a target for reserves? Is retirement on the mind at some point, right? What's the goal for that? And then all the rest of these as we go down through. As we do that, and once we identify those targets, we can start to develop a kind of a graph or ratios for where those different funds are going to go. So this might be what somebody comes up with, right? That you can see the biggest slice of the pie there is back in the business. Okay. Almost all farms and ranches have a long laundry list of, capital improvements that we'd all love to make, right? If we could have it all, or maybe it's upgrading machinery, maybe it's, finally putting a set of corrals over there, right? Whatever it might be. But the list is always long. So for most of the clients that we work with, a substantial amount of their profits go back in the business. Okay. And that's just fine. But what I want to encourage you to do is be thoughtful about those other pieces of profit as well. Okay. So that might be what you would come up with if you were thoughtful about it. This is probably what most farm and ranches look like, right? So when you get to the end of the year, where does it all go? And usually it's not even a conversation. Usually this is happening in somebody's mind, right? Of, okay, we're going to meet our debt obligations. And then the rest of it, we're going to go right back into that list of all these things we want to upgrade, things we want to do, right? And it almost always goes back in the business. It's not necessarily a bad thing as long as the business is working and the business is producing the results that we want, right? Oftentimes we look at farms and ranches that are economically losing money and economically not moving the needle and causing stress and all these kind of things. And if that's the case, it doesn't make sense to reinvest in a business that's not moving forward, right? So I want to challenge you guys to just think about this profit allocation and what can we do with it. There's two broad categories. So if let's say we say, okay, we are gonna put it back in the business. Okay. If I'm going to be sitting on your board of advisors and we've decided, hey, we're going to make a $70,000 capital investment in the business this year, then we could take those capital investments and we could divide them into two main things. Okay. And this might be a little bit different terminology. These will be terms you're used to, but I'm going to use them in a different way. We could take those new investments and we could buy assets or we could buy liabilities. Okay. Now, traditionally in definition, an asset is something of value that we have, right? This is your banker's going to put your assets on your balance sheet, right? List all the things that you have, and the liabilities are going to be things that you owe. Okay. I imagine some of you are readers of Robert Kiyosaki. He has written several different books, and he's challenged this definition of an asset and a liability. And I want to challenge you to think about this when you're thinking about investing profits back into your business. Okay. Kiyosaki says an asset is something that puts money in your pocket. And a liability is something that takes money out of your pocket. Now, using that definition, think about let's think about what might be on your neighbor's capital improvement list. If he's got $70,000 to throw back in the business. Some of those things are going to be things that actually put money in his pocket. Some of those things might be things they're buying that actually end up taking money out of their pocket. So in Kiyosaki's definition, many of the things that we see our neighbors deploying their profit in, they're actually creating future liabilities for themselves. Okay. They're buying things that are going to rust, rot, depreciate. They're buying things that are going to require upkeep, require maintenance, right? Require other tools to support those tools, right? So things that oftentimes become liabilities to us. Okay. Now, I'm not saying all equipment is a liability. There's some equipment that is an asset. Okay. Does the cash flow that this thing produce, is that in excess of the total economic cost of owning it? Okay, that's one way of looking at it. Okay, that's a great definition of an asset. Okay. So I just want to challenge you to say, because oftentimes what we see is a lot of businesses, a lot of farm and ranch businesses, we've got all this stuff, but so little of it is actually producing cash flow, right? For putting more money in the bank at the end of the year, right? Oftentimes, a lot of those things are just creating more and more overheads for us to service year after year after year. Okay. I heard Dave Pratt say one time, if you look at a ranch is full of monuments to tax avoidance. Okay. And you can see that, all right? It's a lot if you look in your neighbor's back lot, right? So I want you to think about this idea of, okay, profit. We're deploying profit. When we deploy this profit, if it's going to go back in the business, let's make sure we're buying things that are going to produce more cash flow in the future, not less. Okay. So as we look at, we're going to start moving into grazing development here with you guys now. As we look at this grazing development, I want to run through and I want to lay out an example ranch, and we're going to talk about how this ranch might do some grazing development, or maybe even if they should. Okay. So here's a ranch. They ranch in an arid environment, primary enterprises, commercial cow-calf, seed stock. We feel like we've been pretty progressive with the grazing management on the place, but we aren't seeing the results we expected. We've invested in water and fence and have the place split into 45 paddocks, but the condition of the pasture seems to stay the same, and we continue to battle undesirable plants every year. Our 400 registered cows calve in February and March, and the 400 commercial cows start in mid-March. So that we can identify sire groups, we break the registered cows into 6 different groups during breeding. We run our commercial herd in 2 groups. We have several other herds, yearling bulls, heifers, and so on. Altogether, we've got about 12 bunches. We have 3 adult children who want to be part of the business. We're eager to have them back, but it'll mean supporting 6 families on the place. I've heard that with improved grazing, we can increase utilization, increase the stocking rate. Our grazing development has slowed the decline in pasture condition, but we haven't been able to push stocking rate up much, if any. I've also heard that with some of these grazing programs, we can increase stocking rate, individual animal performance will suffer. Well, being in the seed stock business, animal performance is very important to us. So how can we increase utilization and maintain animal performance? Okay, so, group that's running commercial cows, registered cows, they've done a lot of grazing development, but they aren't seeing the results they expect. They're leery about pushing the grazing because they don't want to pull performance down on their animals. Okay. I bet some of you probably have already put your finger on some issues on this place, right? So let's before we get into solving this problem here, one of the things I want to stress, and I love good grazing, I love building soil health, but I think one of the things that's often missed is not knowing the economic fundamentals of the business before we get excited about implementing improved grazing. Okay. Let me show you what I mean. Let's take a look at the numbers on this ranch. This is what their profit and loss statement looks like when we break it out by enterprise. Okay. They have 400 commercial cows and they have 400 registered cows. Now, a term we use at Ranching for Profit is gross margin per cow. Okay, you can think of this as how much value does each cow produce that can be used to service overheads and for profit. Okay, so a higher gross margin is good, right? Each cow is producing more dollars to service the overheads and for profit of the business. So you'll probably notice this, right? If my pen here is working. There we go. Look at that. Gross margin per cow on the commercial cows, $400. Gross margin per cow on the registered cows, $300. Okay. If you ask these folks, which are your best cows? They're going to probably say, oh, well, our registered cows are. Really? Okay. If you're ranching for profit, which are your best cows? Okay. In my world, there's one way to define a good cow. A good cow has a strong gross margin. Okay. So in this case, they probably didn't know this before they ran the numbers, right? Many times when we break businesses down into different enterprises, people are unaware of what's really driving the bus in terms of a profitability standpoint. But for these guys, their commercial cows are more profitable than their registered cows. Okay, so if we keep on going with the numbers here, 400 times 400, $160,000 of gross margin there, $120,000 of gross margin there. That means $280,000 of total gross margin, but the business overheads that they're trying to support are $350,000. And so they are making an economic loss of $70,000. So that's kind of our base to work from there. I'll pause just in case Mark or Tanya want to jump in here. Anything going on?
I don't see any questions popping up yet.
Okay.
Must be, oh, wait a minute. I do. Do you have any tools to help the older generation value time in a situation where, this one's probably not completely applicable to sorry, the question is, do you have any tools to help the older generation value time in a situation where the numbers aren't crucial, especially for the older generation?
Yeah, I think I know where they're going on that, and I think maybe let's push that one off a bit here, and we'll pick it back up as we go on. So yeah, I appreciate the question, Rob. We'll try to get to it. All right, so we got this business. We got some commercial cows. We got some registered cows. We got an economic loss at the end. As many of you probably have realized, if I went back here one, let me use this blank page here. If this ranch, it's got how many 12, 40, it was like 45 paddocks or something, and 12 groups of animals when they're in their full grazing program. So if we did the math, this is paddocks on the top and this is groups of animals on the bottom. It's really, they've got about 4 paddocks per herd, right? So it's really no surprise they're not seeing much improvement in terms of the ecology of the place, right? Because if we mapped this out, if this was what the place looked like, if this is a 4-pasture rotation, all the animals are right here, right? This one's recovering, and then we're moving in here, right? And then we're just doing this around and around, and we're really not getting meaningful recovery. And we're probably having too long of grace periods as well. Okay, so there's a lot of things going on here, but this is a ranch that could probably really benefit from some improved grazing management. Okay, one of the points that I probably didn't make as well as I could from that math that I was leading up to is when we get excited about grazing management, about building soil health and doing these things, the first step is knowing what the economics are. Okay, what if, let's go back here to these numbers. What if instead, let's say all we had was, we didn't even have registered cows. Okay, let's just say this ranch, all it had was these 400 commercial cows. Well, if we didn't know our gross margin, this number happens to be 400. What if this ranch sat down to figure out their gross margin and it was actually negative $100 per cow? Okay, and they're going to go back and get good at their grazing and run more cows before they even know that, right? So we have to know what the economic fundamentals are before we get excited about getting better at grazing and increasing the scale of the business, right? What I mean by that is, let's not grow a business that doesn't have good economic fundamentals. Okay, if these guys if their gross margin was negative 100, they went from 400 cows to 800 cows, they're going to go broke faster. Okay. I see a question there from Mike. How much variation do you see from one cow to another? 300 to 400 typical spread. So the variation we see is huge. We have, in the numbers are pretty high right now, and to convert to the Canadian dollar, I'll speak in US dollars. That's what I see more. So you guys do the conversion. We're seeing quite a few on the top end, $800 gross margin per cow numbers coming across. And then I would still say on some of our less the least profitable operations we get a look in, they might be down as low as $200 per cow gross margin. So extremely wide variation from one operation to the next in terms of what gross margin is. And there's we could talk about some of the underlying things there, but there's not just like one answer, right? There's not like one silver bullet. It has a lot of different things. But yeah, those variations can be huge. Okay, so these guys have an opportunity to apply some good grazing. I don't have a lot of, we're not going to have time to spend time on every one of these today. At the Ranching for Profit School, these are the grazing principles that we teach. See if I can clear my ink off of here. Erase all the ink on it. There we go. Principle 1, plan, monitor, manage. Okay. Anytime we talk about a grazing program, we really have to start talking about, we have to start there. Everyone wants like the silver bullet recipe. Here, take 2 of these and call me in the morning. It doesn't work that way, right? Any of you guys that have been grazing very long know that. So it's always about making a plan, monitoring against that plan, and then making adjustments as you go on. Principle number 2, in one word, you could summarize it as recovery. Okay, we have to let those plants recover before we come in again. We could talk all day about what the right recovery period is. But as long as we're paying attention to that, we're going to be good. Principle number 3, short graze periods. Okay, the graze period, the shorter the better. Obviously, there are economic limits to that in different environments. Okay, so we can have some conversations about what that is. But from a plant perspective, from a land perspective, almost always shorter graze periods are better than longer graze periods. Stock density, higher the better. Okay, the higher the stock density, the better. Again, we overlay economic realities onto that. In some places, you just can't justify super high stock densities. But from a land health perspective, stock density can do amazing things for the ground. And then the last principle is match supply and demand. Okay, so these are our grazing principles. Principles work in every environment, right? They always work there. How you apply these principles could look very different, right? How we apply the principles in northern Saskatchewan is going to look different from how we apply them in Wyoming, where I am. Okay, so but these principles are the foundation for that. So I want to run through an example with you guys. Do this in about another 10 minutes here, and then we'll shut her down and take some questions. But let's say we're looking at this ranch that wrote the letter, and we're looking at what some of their pastures look like. And here's just a example pasture. So a 1-section pasture, 640 acres. In this particular pasture, it's got a water right in the middle. And let's say there's nothing landscape-wise that's going to draw animals to one spot or the next. It's just all pretty square. They tend to put 200 cows in there for 60 days. Okay, that's the way it's been grazed for the last 10 years. That's what they tend to do. So if you and I went and rode in this corner of the pasture back up in here and rode down through here and then rode out the bottom, what kind of landscape health would we see in this place? Okay, well, I bet those animals, when they're grazing it, they're going to tend to stay towards the water. So as we looked at that land over time, we'd probably see that area around the water that would have a lot of heavy utilization, right? Maybe there'd be a lot of bare ground in there. As we moved out towards away from the water, we'd probably get to an area where, hey, it probably looked pretty good, right? You're probably still going to have some mix with that long graze period. We're still probably going to have some undergrazed and overgrazed plants. And then as we got out towards the outside, there's going to be a lot of undergrazed plants, right? And you might even see 3 years worth of growth, right? This year's, last year's, even the year after that. So it's certainly not going to be a picture of pasture health and grazed in that way. So what are some ways we could do it? Okay, so let's this is not the correct way to divide this up by any means. This is just a way to allow us to discuss it, right? We could talk about a whole bunch of different ways of what we could do with this pasture. But let's say we did this. Okay? And what I have in mind here is maybe we're using a portable water tank and we're tapping in. Maybe this is a well sitting here with an existing water tank there. And maybe I'm just tapping in here with that above ground surface pipeline and dragging a drinker trough out there. Okay, and then we drag it over this way and we drag it over that way. Okay? And maybe we come in here with a single strand of high tensile wire and do that and run out to those water tanks. So we have electricity out to those tanks. And then we grab ourselves some poly wire and start running some poly wire paddocks like that. Okay. So now we've taken this 640 acres and we've, with a little bit of infrastructure in there, now we've got much better control of our animals. So we'll just move that poly wire and then let those animals go into that next piece. And, we're kind of trying to leave the right amount of residual, not come back to it till it's recovered. And we're also trying to maintain animal condition and performance to what we need. So that's the plan, monitor, manage piece of that. So let's look at the economics of doing something like this. Now I'm going to be pulling some numbers out of the air. My numbers might not be reflective of your numbers. But I want you guys to think about making these changes and thinking back to those principles. What would the difference be in terms of the recovery period of one particular piece of that pasture? Okay, now before, when we were grazing it for 60 days, to make our math easy, let's say it was a 120-day growing season and our animals are in there for 60 days. So the animals are in there for half of the entire growing season. Okay. Well, if we're grazing it and maybe we're in these for a day, 2 days, 3 days, whatever, we're in our little pizza wedges here. Well, now we've got, if it's 120 days, I've got 117 days of recovery period, right? So I've taken my recovery period and I've vastly expanded it from what it previously was. Okay, and graze period. Before we had a 60-day graze period. Now we've got 1, 2, 3-day graze period, right? Whatever it's going to be. So what kind of impact is that going to have on cover, on the water cycle, our ability to capture and hold precipitation, plant vigor, soil health, right? It's going to be a drastic change in that pasture over time. Here's my budget for that improvement. So if I got a movable trough and a drinker, I might spend a couple thousand on that. High tensile fence, maybe 3,000. Poly wire. So I've got a total investment in doing this of $6,000. Okay, now certainly there's going to be some time in there. I did not budget for that time. We could sure add that in. Okay. What's the value of the pasture worth? Here's my math to do that. If there were 200 cows in there for 60 days, if a cow day is worth $1.50 a day, then I've essentially got 200 cows times the 60 days. I've got 12,000 cow days times $1.50 a day. The value of that pasture, the forage value of that pasture for the year is about $18,000. Okay, that was when we had this 200 cows in there for 60 days. Okay. So if we split it up this way, how might we change that? Okay. This is a tool that I often use for budgeting infrastructure improvements on land that we're getting ready to add a grazing system to. Let me spend just a little bit of time explaining this. Okay, the tool is called harvest efficiency. Okay, if some of you guys have read Jim Garish's Kick the Hay Habit book, he talks about the harvest efficiency in that book. Okay, harvest efficiency is the percent of the total annual forage production that ends up in the belly of a grazing animal. Okay, so of the total annual forage, let's say a pasture grew 2 tons of forage over the whole growing season. Okay, so 4,000 pounds of forage. What percent of that forage actually ends up in the belly of a grazing animal? Okay, that's harvest efficiency. Some of it's going to get trampled, some of it's going to get fouled, some of it's going to get left as residual, some of it's going to get lost to insects, right? So what percent ends up in the belly? So here's the way to read this. Here's the graze period. The graze periods are going to get shorter. So this would be 30 days or more. So we could put a plus sign beside that. Okay. 15 days, 10 days, 5 days, 3 days, or a 1-day graze period. Okay. And then we've broken down forage types into either irrigated, improved, or native range. Okay. You can think of this as high precip, moderate precip, low precip, the way to look at it. Okay. So let's look at the native range pasture. Graze periods of 30 days or more, we're going to say we're going to put 25% of the forage in the belly of a grazing animal. So when someone says graze half, leave half, that's pretty optimistic on native range with a long graze period, right? you're actually probably going to get 25% or less in the belly of an animal. Okay. On this example that we're using, I'm going to say that we're going to be in this middle column here. Okay. Improved or kind of this moderate production type of ground. In that 30-day graze period, let's say we were putting about 40% of the total annual forage in the belly of a grazing animal. Okay. When we put in those additional water developments and divided it up, we could get those graze periods down pretty far. Now, maybe in this example, we were going clear down to like a 3-day graze period, right? Where every 3 days we're turning them into a fresh paddock. Well, if that's the case, we could move from a 40% harvest efficiency right on, we could improve that to a 60% harvest efficiency. Okay. So we can use these estimates of additional harvest efficiency to budget the economic return for grazing infrastructure investments. Okay, because I think these are fairly conservative. And the nice thing about these are returns we pick up on day one when the fence and water is in place. Right. As that's been in place for longer, we're gonna grow more grass, we're gonna capture more rainfall, we're gonna get additional improvements. But these are improvements that happen the day we put them in place. So 40% in the belly to 60% in the belly. That's actually a 50% improvement in the total amount of feed that we're harvesting. Okay, can you guys see that? So I was putting 40% of the total annual biomass. Now I'm putting 60%. So my percent improvement is actually a 50% improvement. So if I apply that math to this example, I'm going to take my 12,000 cow days. I'm going to multiply that by 1.5 or a 50% improvement. I can now budget for 18,000 cow days. Cow days still worth $1.50 in my example. I got a $9,000 improvement in my pasture by that improved grazing. Okay. Remember the cost of the infrastructure? Cost of the infrastructure was $6,500 that first year. I picked up $9,000 that first year. That's a 150% return on investment in 1 year. Okay, using those kind of numbers. So asset liability, in this case, it's an asset. Okay. Does that mean all grazing infrastructures are always an asset? No. Sometimes we don't get that big of improvement. The animals have to be profitable, right? Okay. So one more thing here, and I'll stop. Back to our example. There's the 400 back to the example ranch. I bet most of you said, well, let's stop doing the enterprise that's less profitable. Okay. So if we did that, if we replace those registered cows with commercial cows, we're still running 800 cows, but now they all have a higher gross margin. Just by doing that, we've improved the total gross margin of the business. We've taken a $70,000 loss, turned it into a $30,000 loss. By the way, interesting thing to look at there, are we working more or are we working less in this example? Okay. I think that's a lot easier business to run than a commercial herd and a registered herd that's got all these things split up. If we develop some water and we can put these animals together and we can shorten graze periods, increase recovery periods, let's say we could over time grow that herd through improved grazing. Let's make sure we grow a business that has a strong gross margin. Maybe over time we could move from 800 cows to 1,200 cows. Okay. Can you do that? I don't know. Okay. I don't know what your opportunities are. There are a lot of people we've worked with that have seen substantial improvements in stocking rates with good grazing. If they ran 1,200 cows at the same $400 gross margin, now they're making $480,000 of gross margin. Overheads stay the same. It's $130,000 profit. Okay. So we went from losing 70 to making 130,000 by putting our eggs in the right business and then growing that business, and grazing management could be one of those. So there are some things that there's things on this list here are things that we commonly see with the businesses we work with, where deployment of capital back into the business produces a strong return. So we just talked about water and fence, scales for managing shrink, especially in like yearling cattle, livestock with a high gross margin, buying the right types of animals that fit your environment, that you're skilled at marketing, developing marketing skills in yourself, getting rid of some operating debt, family vacation. Isn't it interesting that made the list? Okay. Sometimes actually getting away from the place is what people need to do, right? It's not about working more. It's about creating time to actually be creative. Knowledge for key people. So investing in yourself. So anyway, there we go. That I'll just kind of throw this stuff up here. This is ways you can stay in touch with us. Newsletter. We got a YouTube channel, social media. We've got some books we sell on our websites. There's a lot of podcasts out there you can listen to. Ranching for Profit. Love to have you guys come. Executive link. This is our school schedule that's currently on the website. I was visiting with Mark a little bit. We got 2 schools that we're planning for in Canada this year. One of those is going to be probably in December, probably in Edmonton. We're still working to book the details of that. And the other one is looks like it's going to be in February in Saskatoon. Yeah, but there we go. I'd love to have some questions and discussion.
Well, thank you, Dallas. That's fantastic. And hopefully everyone will remain quiet and I'll get to ask all the questions I want to. But in the meantime, would you like to touch on Rob's question, see if you can tackle that one?
Yeah, great. Thanks for bringing me back to that. Do you have any tools to help the older generation value time in a situation where the numbers are not as crucially, especially for the older generation? Yeah, so the older generation value time. So a few different ways we could go with that. I'm guessing he doesn't mean economically value time. Probably just thinking about how do I simplify the business? How do I create the life and the situation that I want? I'm hoping that's kind of what he's talking about. Well, how are you reading it, Mark?
Yeah, I think that sounds right to me.
Okay. You know, what we often find is it's an interesting thing to look at, and it's going to get a little deep, so I apologize for getting a little deep on here, but we as operators of our own businesses often tend to overcomplicate things. And yeah, the example that I think of is we've gone and worked in the UK quite a bit. The average farm in the UK has about 200 cows and about 300 sheep, and that they make that a full-time job for 2 or 3 people, right? And then you go to Australia and you look at that, and the average, especially out in the outback, the average ma and pop is running 2,000 cows, right? So why do we tend to make our businesses so complicated? And we often create these things that we think we need to do. So what I'm encouraging you to do, Rob, as you think about valuing time, is just really looking with a really critical eye and probably getting an outside eye to look at the things that are going on inside of your business and say, all right, what are the real core pieces of this that I enjoy, that bring me the most fulfillment? And then what are the pieces of it that just are creating distraction and are creating work and frustration for me, and how can I lean into this part that I like and eliminate these pieces that we don't like, and just make sure we're really doing the things that we need to, because I think sometimes we tell ourselves we need to do all these things, but in reality it's a lot of getting in our own heads, if that is so. I hope that was helpful.
Yeah, thanks. Are you able to see the questions, Dallas, or?
I am. Yeah, they're popping up. I see one from Mike. Is that what you're seeing?
Yeah, tie right into it.
Okay. How do you bring in land quality into the equation for profitability? It's tough to cull parts of the fields that don't produce while optimizing the good parts. Yeah, good question, Mike. So what we see when we look at different ranches on the infrastructure improvement part and the grazing part is oftentimes people want to improve the worst stuff, right? There's always those pieces that we all have that are like, we're embarrassed, when we have people and, oh, let's not go look there. Economically, it actually generally makes the best return to work on the stuff that is the most productive stuff first, and leave the lower productive stuff for later on. So the economics of the infrastructure improvement really work well when you're talking about some fairly high productive ground. When you start talking about really low production rangeland, it's really difficult to justify much water and fence on that unless somebody else is paying for it, unless you're getting cost share or things like that to make it work. So definitely land quality comes into the equation. And I would encourage you to look at developing the best stuff before the other stuff.
when you mention cost share, Dallas, there is quite a few programs here that help with water infrastructure and some fencing and stuff too. What kind of things have you seen um, where people have used programs like that really to the best of their potential, and where have you seen them gone terribly wrong?
Yeah, yeah, good question. So that video I put up at the first with our red cows moving, we used down here, it's what we call NRCS that helps us put in pipelines and water tanks. So we did a pipeline across that and water tanks with their cost share. I was really glad I did. It really helped me do it, and it worked very well. The instances where it goes wrong is oftentimes we see when we get these programs involved, their technical requirements cause us to drastically overbuild it for what it would be if like you or I were doing it ourselves, right? So oftentimes, you need all this additional bedding and these kind of things that don't make a lot of sense. Sometimes the fences that they prescribe in there, where a 1-wire high tensile would do, they want some crazy 6-8 wire thing, that's going to keep elephants out or something. And oftentimes we can say, well, hey, I'm getting 70% cost share on the deal, but the price just went up by 4-fold as well. Right. So really sometimes your ultimate price you pay can almost be the same even without the cost share. The other thing that can really cause problems is the slow pace. Now, maybe you guys have it better up there, but oftentimes we'll see people that say, hey, I really want to do this development here, and then they're waiting on the cost share. And sometimes that waiting takes 2 years, right? Well, if this other infrastructure we just looked at on this example ranch, right? If they paid for it out of pocket in 1 year, they're picking up their money plus some, right? If they had to wait 2 to 3 more years to do that, that's very costly waiting for cheap money, right? So sometimes you're better to just do it yourself and do it now and do it the way you do it rather than waiting on free money. But other times it works really well. So it down here, it really varies on what office you're working with and how aggressive the staff is at helping to shuttle stuff through. So.
And those decisions on whether or not to jump in or to do it on your own would be quite a bit easier if you've got all of your numbers laid out in front of you.
Yeah, I agree.
Yeah.
Yep. I see Laura's question there. Is that the next one?
Yeah.
Okay. I like that question, Laura. Thanks for asking that. What has been your experience with farm businesses that have a lot of different enterprises versus those that focus on just 1 or 2 main enterprises? Can they both be successful? Yes, they can both be successful. I'm going to give you my perspective here, which is probably not shared by other folks, but take it for what it's worth. It's one person's perspective. So the businesses that we see that are the most profitable businesses are those that tend to do 1, 2, or 3 things well and at scale. Okay. So what is the thing that you're good at? What's the thing that your skills lead you to do? And then we identify that thing, we have a strong gross margin, and we lean into it and we hit the gas on it and we scale it. Okay. That doesn't mean our business does only one thing. Maybe we do this and this really complements this really well. So we do those 2 things, right? And we really hit the gas on it. What has become popular over the last few decades are businesses that do lots of little things. Okay, and this is well intended to where these people got to, but the economics of it rarely work, right? So it's the idea of, well, I'm raising cows and I've got my calves to sell, and it's the fall of the year, and I don't like what the calves are bringing, so I'm going to keep my calves and I'm going to run them as yearlings. Well, then I get to my yearlings and I'm like, well, you know what? They're almost finished. I'm going to keep them and finish them, and then I don't like what the Packers paying, so I'm going to sell them myself, right? So now we've got a cow calf business, we've got a stocker business, we've got a grass finishing business, and now we've got a direct marketing business, right? So we've got all 4 of those things laying on what might be a small farm to begin with. And then I go and I sell my beef to my friends and neighbors who are doing this. And when I deliver beef to them, what do they ask for? Well, they say, well, do you have any sheep, any lamb to go along with these? Right. And I go, well, yeah, I don't, but you know what? Next year I will. So now I've got my beef herd and I've got, 3 or 4 herds for these animals that have different nutritional requirements. And now I've got a flock of sheep and then I add chickens to it and then I add pigs to it. And now I'm growing vegetables in my garden and I'm going to 3 different farmers markets on the weekends and I have 4 different drop-off points and I'm dealing with my packer over here and dealing with this over there. So what we tend to see in those kind of businesses, lots of extremely busy people that are really frustrated and they have no idea where their profit's coming from at the end of the year because there's so many small little things going on that nothing is really pulling the cart, so to speak, right? And so there's just a lot of minutia. So I say that as an example. There's a few of those I've seen that work, but there's a heck of a lot more of those I see where the principles of the business are just about ready to pull their hair out.
Yeah, great. Well, if no one else is going to jump in, I'm just going to keep firing them away until I get kicked out. When it comes to starting into the rotational grazing, oh, and Dana jumped in right at the nick of time. Okay, we'll let her go first.
What if you have 2 enterprises and you went down to 1 and it's still not at the scale that it needs to be profitable? Okay, cool. I'm going to do a visual for this one, Dana. I'm going to share my screen here again. And I'm going to go back to we're going to use this page right here. Okay. All right. So the way we did that is when we looked at the numbers is we calculated gross margin and then we did overheads. Okay. And then underneath overheads was profit or loss. Okay. So when we're engineering a business and working through that, we actually work from the bottom up. Okay. So what I would want to ask you to do, and I mentioned this briefly in the talk, is identify your profit target. Okay. So I'm gonna walk you through a scenario, a series of questions where we're going to come up with a profit target for your business. Let's say it's 50,000. Okay, just to put a number down there. Okay, and that would be your profit target. And then we're going to look inside your business and say, okay, what overheads are we expecting this business to support? Okay, so these would be things like owner salary, other salaries, land upkeep, land taxes, the base level of machines, so repairs and depreciation on a pickup and a trailer or whatever kind of machines you have. And so let's say in overheads there's another $50,000 of overheads. Okay, so when we look at that, we realize that in order to cover our overheads and meet our profit target, I need a business with $100,000 gross margin. Okay. Now, if you said to me, okay, I've got this one enterprise and it produces $1,000 gross margin per unit. Sorry about my messy handwriting. It's hard to write with this pen. Well, then it's pretty easy to see, right? If this is $100,000, we need to be able to run 100 of those units to meet that thing. Well, you might say, but my business is only scaled enough right now that I can only run 25 of those things. Okay, so I'm only producing $25,000 of gross margin, but I want to be producing 100,000. Okay, so that's when we'd step back and say, okay, is it a reality to grow this business through good grazing, through picking up additional leases, through whatever those might be to hit these targets? Or do we have to come back to the drawing board and find a business that has even a better gross margin? Okay, we've an example of that would be, we work with a lot of ranchers that, hey, we want to run cows. All right, well, let's run your numbers on your cows. Yeah, but I also want to support 2 families and I also want to be, really, really profitable and I want to do all these kind of things. Okay, well, if we're running a business that can only run 200 cows and you want to be really profitable and support 2 families, cow calf is probably not the right thing to do on that, right? So we probably need to come back to the drawing board and find an enterprise that has a much higher gross margin that we could layer onto this thing to produce the outcomes that we want. So I hope that makes sense. I feel like I kind of rambled around there a bit, but we reverse engineer it as the answer.
Yeah, yeah, I think that covers it really well. Well, we've kind of talked about a hard stop at 8 o'clock, but I'm going to try to sneak one more question in, Dallas. So you'll just have to
All right.
talk fast if we start running out of time. Um, so many times when people want to jump into rotational grazing and they want to start with the infrastructure development, they want to get to the finish line with the very first step. They want to get everything exactly how they want it in the very end, right off the bat, and so many times that's really hard. What do you see producers having success with when it comes with first steps as far as getting infrastructure for um, just for things that they don't regret doing, things that they don't have to redo, and for things that help them understand better what their next step should be?
Cool. Good question, Mark. The way I drew this out when I was talking about it was using the existing water point here and then using some temporary waters with above ground pipeline. That would be a fairly low cost trial method to say, let's see how this works for me, right? And so you're tapping into an existing water point. Maybe I know, hey, I'm going to need 2-inch pipeline on this, so I'm going to buy 500 foot of 2-inch pipeline and lay it on the ground for the first year, and then have an above ground movable drinker, right? So that would be a really nice way to say, here's where I think I want my water points. Let's try them out, right? And then I could pretty dang easily. I mean, if that's single strand high tensile wire, if that's 640 acres, that's what, 3 miles of fence. What is that? A couple days worth of work to have that in, probably, if the soil's not too hard. So with a fairly low investment, a person could be pretty well set up with a system like that. Now, where I see things going wrong is folks are going to say, well, I'm just going to really cheapen out and I'm going to stay with this above ground movable water system from now to eternity, right? You're probably going to hate it after a little while, right? So after that first season, when you've done those temporary things and you say, yep, I picked the right point, this is where I want my water points, that's when we put it in, and we put it in right. Whenever you put pipe in the ground, always go up one side you need. Right. A lot of our clients have said, well, I think I need to put 300 cows out there, so I'm going to put 1.25 inches in it. Right. And within a couple years down the road, hey, I'm no longer year-round grazing this. I'm seasonal grazing it. I'm no longer using cows. I'm using another class of livestock. Now, instead of 300 cows, I'm putting 1,000 yearlings in there. Right. Well, that 1.25 inches, no way is going to keep up with those 1,000 yearlings. So our advice is always go, whenever you're putting pipe in the ground, always go bigger. It's not very uncommon at all to see people say, I wish I'd have put a bigger pipe in the ground. So make sure you do the water right the first time, and then always overbuild your water system from a supply standpoint. The fence is easy, cheap, as long as you're not putting in 5-strand barbed wire. You can put it in and change your mind next year, and it's not that big a deal. So that'd be my advice. What would be your advice, Mark?
No, you nailed it. Putting things up temporarily, whether it's water or fence, is a fantastic way to figure out why you didn't want it there in the first place and why you want to move it someplace else. Or if you put up temporary stuff 2 or 3 years in a row in the same place, then obviously you've chosen well.
Yep, I agree. Cool.
Well, that is great. We have run out of questions. Well, there's no more questions coming. I could stay here all night, but we've also hit 8 o'clock, so I think we're gonna call it for now. Thank you very much, Dallas. This has been great. You were part of our very first webinar, and yeah, it's been great. Thank you very much.
Cool. Well, thanks for having me. Appreciate the questions, everybody. So yeah, thank you.
All right. Okay, that's everything. We're gonna shut her down. Thanks, everyone. And like I said, if you're interested in this kind of stuff, pop onto the website and check us out. Thanks, everyone.
Yeah.